You need to understand something that's happening right now in the silver market, something that hasn't happened in decades. And if you're holding cash, thinking you have time to make a decision, you need to hear this. Dealers are running out of physical silver, not just low inventory, not just delayed shipments. We're talking about actual supply disruption at the dealer level, the kind of thing that precedes massive price moves. Let me paint you a picture of what's actually happening on the ground right now. Major bullion dealers across the country are reporting something they've never seen before. Customers are calling to buy silver eagles, silver rounds, even junk silver bags, and they're being told the same thing. We don't have it. We can get it to you in 6 to 8 weeks. 6 to 8 weeks. For the most liquid precious metal on Earth. This isn't some conspiracy theory. This is dealers picking up the phone and telling customers they can't fulfill orders. This is premiums on physical silver climbing to levels we haven't seen since the panic of early 2020. This is the market screaming that something fundamental has broken. And here's what makes this absolutely critical. This is happening while silver is still trading under $35 an ounce. Imagine what happens when the broader market wakes up to this reality. Let me take you inside what's really going on. The silver market operates on a very specific structure. You've got mining production, you've got recycling, you've got industrial demand, you've got investment demand, and you've got this paper market that trades hundreds of times more silver than actually exists. It's a delicate balance that's held together by the assumption that physical delivery will never be demanded in size. That assumption is being tested right now. Investment demand for physical silver has absolutely exploded. We're not talking about a modest uptick. We're talking about demand that's outpacing supply by over 176 million ounces. That's not a typo. The deficit between what people want to buy and what's available is staggering. And this isn't just retail investors buying a few coins. This is institutional money, family offices, sovereign wealth funds, all moving into physical silver in size. They're looking at the same data you and I are looking at, and they're reaching the same conclusion. Silver is grotesquely undervalued relative to everything else. Think about what silver actually does. It's the most conductive metal on Earth. It's irreplaceable in solar panels, in electronics, in medical applications, in water purification. Every single trend that's supposed to define the next decade, electrification, renewable energy, advanced manufacturing, all of it requires massive amounts of silver. The solar industry alone is projected to consume over 200 million ounces of silver annually within the next few years. That's roughly a quarter of total global production, and that's just one sector. Electric vehicles use twice as much silver as traditional cars. Data centers, AI infrastructure, 5G networks, all of them are silver intensive. We're building out this massive technological transformation, and silver is the metal that makes it possible. So you've got this structural demand that's only going one direction, up. And at the same time, you've got mine production that's essentially flat. Silver isn't like gold where you can just go find more of it. 70% of silver comes as a byproduct of mining other metals, copper, lead, zinc. You can't just open a silver mine when the price goes up. It doesn't work that way. This creates a very specific dynamic. Demand is surging. Supply is constrained. And the market is starting to realize that the paper price and the physical reality are two completely different things. Let me explain what I mean by that. On the COMEX, the commodities exchange where silver futures trade, you can buy and sell contracts representing 5,000 ounces of silver. Most of these contracts never result in physical delivery. They're just bets on the price. Traders buy, traders sell, and at the end of the day, they settle in cash. But here's the thing. The COMEX has rules that allow for physical delivery. If you own a contract and you want the actual metal, you can demand it. And when enough people start demanding physical delivery, the whole structure gets stressed. Right now, the amount of silver available for delivery on the COMEX relative to the open interest, the total number of contracts outstanding, is at historically low levels. We're talking about a ratio that suggests if even a small percentage of contract holders demanded delivery, the exchange wouldn't have enough metal to fulfill those requests. This is what's called a squeeze. And it's not theoretical, it's happening in real time. You can see it in the premiums. When you go to buy physical silver right now, you're not paying spot price. You're paying spot plus a premium that can range anywhere from $4 to $8 per ounce depending on the product. That premium is the market's way of saying physical metal is scarce. You can see it in the delivery times. Dealers who used to ship within days are now quoting weeks or months. That's not a logistics problem. That's a supply problem. You can see it in the behavior of the big players. Central banks aren't buying silver the way they buy gold, but sovereign wealth funds and institutional investors absolutely are. They're taking delivery of physical metal and storing it in allocated accounts. They're not interested in paper claims. They want the real thing. And this is where it gets really interesting. There's a concept in markets called backwardation. Normally, the futures price of a commodity is higher than the spot price. That's because there's a cost to storing and insuring the metal over time. But when a market goes into backwardation, the spot price is higher than the futures price. That means people are willing to pay more for metal today than for a promise of metal in the future. Silver has been flirting with backwardation. That's a massive red flag. It means the market is saying, I don't trust that I'll be able to get metal in the future, so I'll pay a premium to get it now. This is the kind of thing that happens right before a market breaks. Let me give you some historical context. In 1980, silver hit $50 an ounce. That wasn't because of industrial demand. That was because the Hunt brothers tried to corner the market. They bought massive amounts of physical silver and silver futures, and they drove the price to levels that forced a regulatory intervention. In 2011, silver hit $49 an ounce. That was during the aftermath of the financial crisis, when investors were fleeing paper assets and piling into hard assets. Silver went parabolic, and then it crashed when the speculative fever broke. But here's what's different about right now. In 1980, silver demand was primarily investment-driven. There wasn't this massive industrial consumption we have today. In 2011, the move was driven by fear and speculation, not by fundamental supply-demand imbalances. Right now, you've got both. You've got the investment demand, because people are waking up to the fact that the dollar is being debased, that inflation is structural, that the financial system is fragile. And you've got the industrial demand because we're in the middle of this massive technological build-out that requires silver in quantities we've never seen before. This is a fundamentally different setup. This isn't a speculative bubble. This is a supply-demand crisis that's been building for years and is now reaching a breaking point. And the dealers are the canary in the coal mine. When dealers can't get metal, it means the supply chain is broken. It means the refineries can't keep up. It means the mints can't produce enough coins. It means the wholesalers don't have inventory. It means the entire physical market is under stress. And here's the kicker. Most people have no idea this is happening. The average investor looks at the silver price and sees it trading in the low 30s and thinks, it's been there before. No big deal. They don't see the premiums. They don't see the delivery delays. They don't see the tightness in the physical market. But the people who are paying attention, the people who understand how these markets work, they're acting. They're buying now. They're taking delivery. They're getting their metal while they still can. Because once this breaks, once the broader market realizes that physical silver is genuinely scarce, the price is going to move in a way that shocks people. Think about what happens when a market that's been suppressed by paper trading suddenly has to reconcile with physical reality. Think about what happens when industrial users who need silver for production start competing with investors who want silver for wealth preservation. Think about what happens when the COMEX has to either deliver metal it doesn't have or change the rules to prevent delivery. Any one of those scenarios sends the price significantly higher. All of them happening at once? That's a moonshot. Now, I want to take a quick aside here because this is relevant. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, and you're concerned about what we're talking about, there's a way to get physical precious metals into those accounts without triggering taxes or penalties. It's called a gold IRA, and it works with silver too. I put together a free guide that walks through exactly how it works, what the rules are, how to set it up. It's in the description below. If that's relevant to your situation, it's worth checking out. No pressure, just information. All right, back to what's happening in the market. Let's talk about what this means for price. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. Gold is primarily monetary. Copper is primarily industrial. Silver is both. And that creates a very specific dynamic when supply gets tight. Industrial users can't just stop buying silver because the price goes up. They need it for production. If you're manufacturing solar panels or electronics, you can't just substitute something else. Silver is irreplaceable in most of its applications, so industrial demand is relatively inelastic. Price goes up, they keep buying. Investment demand, on the other hand, is highly elastic. When the price starts moving, when people see silver breaking out, when the narrative shifts from silver is cheap to silver is scarce, investment demand explodes. You get momentum buyers, you get FOMO, you get people who've been sitting on the sidelines suddenly rushing in. This creates a feedback loop. Higher prices attract more investment demand. More investment demand tightens physical supply. Tighter physical supply pushes prices higher, and round it goes. We saw this in 2020 during the initial COVID panic. Silver went from $14 to nearly $30 in a matter of months, and that was with the economy shutting down, with industrial demand collapsing. Imagine what happens when industrial demand is strong and investment demand surges at the same time. The technical setup right now is absolutely screaming for a major move higher. Silver has been consolidating in this range for months. It's built a massive base. Every time it dips, buyers step in. Every time it rallies, it holds the gains. This is classic accumulation. Big money is building positions, and they're doing it quietly, without pushing the price up too fast. But that can't last forever. At some point, the coil springs. At some point, the breakout happens. And when it does, the move is going to be violent. Look at the gold-silver ratio. This is the number of ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1. Right now, it's trading in the 80s. That means silver is cheap relative to gold. When that ratio reverts to the mean, and it always does, silver either has to go up or gold has to come down. Given everything we know about monetary policy, about inflation, about the fiscal situation, gold isn't coming down, which means silver has to go up. A lot. If the ratio goes back to 60 to 1 and gold stays where it is, silver goes to $45. If gold continues higher, which it likely will, silver goes even higher. And if the ratio overshoots to the downside, which it often does during silver bull markets, you're looking at $50, $60, $70 an ounce. And that's just based on the historical relationship with gold. That doesn't even account for the supply-demand fundamentals we've been talking about. Now let's talk about what happens when the paper market breaks. The COMEX has been the price discovery mechanism for silver for decades, but it's a paper market. It's a market where contracts trade, not metal, and as long as everyone is happy to settle in cash, the system works. But what happens when people start demanding physical delivery in size? What happens when the industrial users who have been buying futures to hedge their production needs decide they want the actual metal? What happens when investors who've been holding paper silver in ETFs decide they want allocated storage? The system breaks. It has to, because there isn't enough physical metal to back all the paper claims. When that happens, one of two things occurs. Either the price of physical silver decouples from the paper price, and you end up with a two-tier market where physical trades at a massive premium to paper. Or the paper market collapses, and price discovery shifts to the physical market, which sends the price to wherever it needs to go to balance supply and demand. Either scenario is bullish for people who own physical metal. Either scenario is a disaster for people who own paper claims. This is why the dealers running out of inventory is such a critical signal. It's the physical market saying, we can't keep up. It's the first crack in the dam. And once that dam breaks, the flood is going to be spectacular. Let me give you another angle on this. Central banks around the world have been accumulating gold at record pace. They're diversifying away from dollars, away from euros, away from fiat currencies in general. They understand that the monetary system is changing, that we're moving toward a multipolar world where no single currency dominates. But here's what's interesting. While central banks are buying gold, private investors and institutions are increasingly looking at silver. Why? Because silver is more affordable, more accessible, and has this industrial demand component that gold doesn't have. If you're a family office with $50 million to deploy, you can buy a meaningful position in physical silver. You can take delivery, store it, and wait for the fundamentals to play out. You can't do that as easily with gold at current prices. This is creating a dynamic where silver is becoming the preferred hard asset for a certain class of investor. And as more money flows into that trade, the supply situation gets even tighter. There's also a geopolitical dimension to this that people aren't talking about enough. China has been stockpiling silver for years. They're the world's largest producer of solar panels, the world's largest manufacturer of electronics. They understand that silver is strategic. They understand that controlling the supply chain for critical materials gives them leverage. If you're China and you're looking at a world where the West is trying to reshore manufacturing, trying to build out renewable energy, trying to reduce dependence on Chinese supply chains, what do? You lock up the materials they need. You accumulate silver. You make it harder for them to execute their plans. This isn't speculation. This is basic geopolitical strategy, And it's another reason why physical silver is becoming scarce. Now, let's talk about what you should be thinking about if you're considering a position in silver. First, understand that this is a physical market story. Paper silver, ETFs, futures contracts, those might do well if the price goes up. But if the real story is a breakdown in the physical market, you want to own the physical metal. You want it in your possession or in allocated storage where you have direct title to specific bars or coins. Second, understand that this is a patience trade. The fundamentals are screaming. The technicals are set up. The supply situation is critical. But markets can stay irrational longer than you can stay solvent. This could take months to play out. It could take years. But when it goes, it's going to go fast. Third, understand that silver is volatile. It's not gold. It doesn't move in a steady, predictable way. Silver whipsaws. It spikes. It crashes. It does things that make you question your sanity. If you can't handle that volatility, if you're going to panic sell when it dips, then maybe this isn't the right trade for you. But if you understand the fundamentals, if you can handle the volatility, if you're willing to be patient, then this is one of the most compelling setups in any market right now. Because here's the bottom line. The supply of physical silver is running dry. Dealers can't get metal. Industrial demand is surging. Investment demand is accelerating. The paper market is stretched to the breaking point. And the price is still under $35 an ounce. That's not going to last. When this breaks, when the market reprices silver to reflect the physical reality, the move is going to be historic. We're talking about a potential doubling, tripling, or more from current levels. We're talking about a generational opportunity in a market that most people aren't even paying attention to. The dealers are sounding the alarm. The question is, are you listening? Because once the broader market figures this out, once the headlines start talking about silver shortages, once the price starts moving in a way that captures attention, it's going to be too late to get in at these levels. The smart money is acting now. They're buying physical metal. They're taking delivery. They're positioning for what's coming. The supply of silver just ran dry. The dealers know it. The institutions know it. The industrial users know it. Now you know it too. The only question is, what are you going to do about it?